What's up, financiers? It's E of E&L Finance. In today's episode of the M1 Finance Challenge, we're going to be looking at the growth portfolio and how we're going to rebalance all of the portfolios to better suit our needs. If you're new to the channel, welcome to the Bull Bear of Investing, where we are a group of friends that are basically a family and newly investors, recording our journey to financial freedom. So we'll greatly appreciate if you hit that like button and subscribe for further videos on stocks, investing challenge, and innovative ways to invest. So normally we put together a script that we record for our videos. But for this episode, it's going to be my live thought on how this portfolio is going to be reamped, reshaped, and refocused. For the first episode, we talked about how we built 3 portfolios along with a growth portfolio. The first one being the aristocrat portfolio, full of companies that have 30 to 50 years of paying a dividend without any interruption. The second was the balanced portfolio, full of companies that we believe have the potential to continue to grow along with their dividend. Each portfolio has one company to represent one of the 11 sectors. And the third portfolio is the maximum gain portfolio, full of strong companies that have positioned themselves to pay high dividends without a crazy high dividend yield. What we didn't talk about last episode was our high growth stock portfolio. For those that have watched the first episode, you may have noticed that our overall percentage for each portfolio has changed. Each portfolio was 25%, and we recently changed it to better fit the portfolio's goals, which is to become a reinvesting automated portfolio, which is going to be done by creating enough dividends from the aristocrat, balance, and maximum gain portfolio in order to reinvest those dividends into the growth portfolio while also reinvesting into their individual portfolios. So if we had each portfolio at 25%, we weren't really growing the overall account. So we figured it'd make more sense to have the 3 dividend portfolios at 30% and the growth portfolio at 10%, because right now our goal is to start creating enough dividends for it to reinvest into itself. So in the last episode, we didn't get a chance to talk about the growth stock since our main focus was introducing the 3 dividend paying portfolios. So we're going to go into the high growth stock portfolio today. When we built the high growth stock the first time, I believe it consisted of 17 companies. We're going to restructure this portfolio today because we kind of got carried away with such great growth stocks. We kind of strayed away from the overall goal for this challenge. So for the time being right now, we don't need to have so many growth stocks in the high growth stock pie because we need more money going to the dividend stocks to acquire more shares. In the long run, the 3 dividend generating portfolios will generate enough money to invest into the high growth stock portfolio. So right now we're going to restructure this. We have Google at 10%, Amazon at 10%, Facebook at 10%, and these companies at 5%, which are AMD, Airbnb, Alibaba, Etsy, Netflix, PayPal, Snow, Square, T-Mobile, Tesla, with Shopify at 4%, 3D Systems at 3%, Qualcomm at 3%, Salesforce at 3%, Spotify at 3%, and Uber and Zoom at 2%. 3D Systems is a company that focuses on 3D equipment and is a dominant player in the 3D industry. So what we're going to do now is we're going to remove some of these growth stocks and reduce the growth stock portfolio to maybe 7, maximum 10 companies because we want to allocate more money elsewhere. The reason why we need to restructure this is because we came up with a budget of $50 a week for this challenge. And between the 3 dividend portfolios, that's 33 shares per pie. And with the growth stock portfolio, we had 53 companies, and with a budget of $50, that wasn't investing much. So now we're restructuring the growth stock portfolio. So the companies that we're keeping in this portfolio is Google, Facebook, AMD, Netflix, Alibaba, because we believe that Alibaba is going to come back as the dominant e-commerce in China. We're going to remove Airbnb because even though Airbnb has an interesting business structure, it still has a lot of room to grow and recover from pandemic losses. So when we put the percentages to 0, it's going to sell whatever stock we have of these companies the following trading day. We're going to keep Netflix because even though it has new competition and more competition arising, it's still a dominant player as far as content. They have award-nominating movies, award-nominating shows. They continue to produce good quality entertainment. And it's going to be a while before these new platforms are able to catch up to Netflix status. We're also going to keep Tesla. I know, Tesla. But despite the controversies or any negative news, Tesla is still a leading industry in advanced technology and advanced equipment like the EV cars. Not only that, they're experimenting with space travel, and soon they're going to be able to privatize traveling into space. We're going to also keep T-Mobile because it is an expanding telecommunicating company, and with their recent acquire of Sprint, they've grown even more and expanded their towers and their reach to different types of customers in different regions. So this is harder than I thought, trying to decide what companies to keep. So we're going to also keep Square. Man, saying goodbye to these companies is hurting the soul. But we know in the future we're going to re-enter into these companies. So right now we're changing the percent of how much we want the money to be invested into each of these companies. So I'm just going to play around with the percentage right now until I feel like it's looking good. So let me remove these companies that we no longer need. Now we're going to save what we have. It says, are you sure you want to save your changes? Any stocks that are no longer there will be sold the next business day. And now we hit confirm. So we actually ended up with 9 holdings for the growth stock portfolio. So we have Google, Tesla, AMD, Amazon, Netflix, T-Mobile, Alibaba, Facebook, and Square. We didn't do this before, and I apologize, but here's the percentage within the maximum gain portfolio. We have 15% for Apple, 15% for Pepsi, 10% from Home Depot, 9% for Allstate, 9% for American Electric, 9% for Caterpillar, 9% for Cracker Barrel, 9% for Crown Castle, 9% for AbbVie, 5% for AbbVie, 5% for ExxonMobil, and 5% for Public Storage. Just to show you what I mean about the maximum gain portfolio, Pepsi pays, I believe, $1.50 per share, and yet their dividend yield is 3%. Now going over the balance portfolio, we have Target at 10%, Abbott Labs at 9%, Domino's at 9%, Duke Energy at 9%, Honeywell at 9%, JP Morgan at 9%, Microsoft at 9%, Realty Income at 9%, Sterling and Black & Decker at 9%, Verizon at 9%, and Waste Management at 9%. Now moving on to the aristocrat portfolio, we have AT&T at 15%, J&J at 11%, 3M at 9%, Federal Realty Investment at 9%, IBM at 9%, PBG Industries at 9%, Procter & Gamble at 9%, Con Ed at 9%, Aflac at 7%, Chevron at 7%, and McDonald's at 7%. So just a quick reminder, when we started to invest the challenge, we invested $100 because that was the initial deposit we needed for M1 Finance, and we're currently up $5.48. This is how much each portfolio is currently worth. Our original thoughts was to invest with this portfolio every time there was a market sell-off, but we came to a conclusion that if we were to do that, it wouldn't matter, because if we were to invest weekly, whether it was up or down, we're still building the portfolio at a faster rate compared to if we were to wait for market dips. So with our $50, it's going to be spread into 30% for the aristocrat portfolio, 30% for the balanced portfolio, 30% for the maximum gain portfolio, and 10% for the high growth stocks. Because we rebalanced the high growth stock, we have 6 buys and 8 sells for tomorrow. And now we're going to put in our $50 for this week. And now our deposit is complete. We hope this video was helpful in some way. and want to thank you for watching. And as always, if you find this information useful, don't forget to smash that like button, subscribe to our channel, and set your alerts to receive more content like this one. See you guys in the next one, and remember to follow the 3 M's. Money makes money.